Hey everybody, what's up? It is Friday, August 30th, the last Friday in August. Like that's it for the summer. Let's talk about the dollar, US dollar. I haven't mentioned that in a while. It's been kind of in a sideways, creeping back up. Today, the dollar index made a new 2-year high. I think we hit 99 or slightly over 99. So the last high was what, 98, 93, I believe, that we hit sometime back in August, earlier this month. And now we hit 99. Now let's recap. And by the way, this is the dollar index. If you look at individual currency pairs, even though today actually the euro hit a new 2-year low against the US dollar, but and I believe the New Zealand dollar also traded to a new low. However, British pound did not, Australian dollar did not, Canadian dollar did not, Turkish lira did not, South African rand did not, the yen way far away from its low. As a matter of fact, it is looking at multi-year highs, very close to multi-year highs against the dollar. So it's a mixed bag, okay? I'm talking about the dollar index right now. We hit 99, maybe slightly above. The last print I saw was 99. In January 2017, the dollar index was at 103.84, I believe. And in February last year, February 2018, it was all the way down at 88.25. So it went from 103.84 in January 2017 all the way down to 88.25. And in the last, 18 months, it has slowly creeped back up to 99, where it is right now. So still significantly below the 103.84 level that it hit in January 2017. We had, how many rate hikes did we have in the interim? We had something like, I lost count. We had 5, 6, 7, 8 rate hikes or something like that. And we had one rate cut that happened last month in July. So we had something like 7, 8 rate hikes. All right, since December 2015, and we had one rate cut. We have seen the U.S. budget deficit blow out. Now it's about $1 trillion. I believe at last count it was $938 billion so far for this fiscal year. It'll be over $1 trillion by the end of the fiscal year, which will be September 30th. And the trade deficit is at multi-year lows. What's it, like $56 billion a month, running like that. So the tariffs actually, you could make a case, you could make a bullish case for the currency, for the dollar, if the tariffs were resulting in a rapid shrinkage of the U.S. trade deficit. What happens with these trade deficits? The world accumulates more and more dollars, and markets are then affected by forward sales of dollars, hedging, all that type of stuff. The accumulation is not what causes it to go up, because the accumulation, you can make a very, it's very easy to see. If you go back to 1971, when the U.S. went off the gold standard internationally, the dollar's been going down, basically for 50 years. It's had some blips up, but there's been exponential amounts of new accumulation of dollars. Remember, under a floating exchange rate system. I'm not talking about a gold standard anymore. I'm not talking about a fixed exchange rate. We're in a floating exchange rate system. The demand for the currency literally creates more of that currency. All right? So you can see the dollar, if you go back and if you look at a chart of where the dollar index was in 1971 and where it is right now, even with this rally, it is way down below where it was. And that's not an indictment of the dollar. It's not a negative thing. I'm just explaining, okay, that the demand for the currency, the more the rest of the world wants to hold dollars, the more dollars are created. All right, the supply of dollars goes up. So we've had this rally back from 103.84 in the dollar index down to 88.25, back up to 99. Now it's been going on, I'll be honest, it's been going on longer than I thought. I mean, I've gone back and I've looked at some of these counter trend moves up and down, and you know, they could last anywhere from 6 months, 8 months. I've seen them 11 months, a year. This is a long one, 18 months. But, and you can make a case for why some of these currencies, other currencies, are weak. I mean, these countries need to really stimulate growth, and not in the fashion of these cockamamie monetary policy ideas that they're putting in place. But then again, you see the dichotomy here between, take for example a currency like the yen, where you have negative interest rates, asset purchases by the central bank, and the yen is very strong. Then you take the example of, let's talk about the euro, where you have interest rates 0 to negative, asset purchases, well, they ended that recently, and the euro is very weak. So you see the dichotomy there, where in one case, where I believe in the yen's case, those monetary conditions are playing out on the yen as they should. That's a bullish monetary condition. You are removing yen from the system. The negative rate is like a tax. The asset purchases take away income, takes away assets. The same should hold true for the euro, but it has not up until now. Although the euro is higher than where it was back in 2016, 2017, 2015, whenever that low, it hit a low of about 103.40 against the dollar. And looking at these dichotomies, and also looking at the what I just mentioned in terms of the U.S. picture with the expanding trade deficits, the expanding budget deficits, and seeing the dollar very, very strong, where any economics 101 would tell you that those are the conditions by which you would see the currency decline. The fact that it is strong and it is held up tells me that it is a rally in a bear market. Now, when it stops, I don't know, but it will stop, and it will revert lower. That's just fundamental. So here we are at a juncture where some currencies, and I would say the minority of currencies, are making new lows against the dollar. It is pushing the dollar index up. But many of them have already hit their bottoms and have started to come back up. So the situation is one in which we have to let this play out. Ultimately, the dollar will head lower. There is no fundamental policy right now in place to really support the dollar and drive it higher over a longer period of time. We have higher inflation in the United States than many of these counterpart countries that I mentioned, the Eurozone, for example. Much higher inflation here. All right. So you're buying basically a currency that is being inflated. Yes, there's an interest rate, but you're losing on that. The real rate is negative because inflation is higher than the interest rate you're earning, so etc. So that is the picture. Now let me quickly mention stock market. There's a tremendous amount of negative sentiment still. I believe the market is going to move higher, but I want to see the fiscal flows, as I have mentioned in the last few videos. They're a little bit concerning to me. There has been a slowdown in the rate of growth of the fiscal flows, and Yesterday, I saw something a little bit constructive. If you want to know what I'm talking about, you got to sign up for a 30-day free trial of MMT Trader. Go to my website, pitbulleconomics.com, and sign up. All right, everybody, have a great weekend. I'll see you probably not on Monday, probably on Tuesday. Enjoy your Labor Day holiday. Bye-bye.